Welcome to the Canadian Investors Course, Session 2, the continuation of income investing. Note that on page 2, there's the terms of use and disclaimer slide as fully read in the introduction. Please read it again. Slide 3 is a cartoon regarding bailouts. And you've got Uncle Sam looking to Uncle Sam for money, and the safe is empty. So anyway, Session 2, medium and long-term income investing. On slide 5, you'll see a collection of pie charts. We'll return to this a little later in the sessions, but you'll notice that the first slide number 1 has a large amount of fixed income, a relatively small amount of each of the forms of equity, and number 4 has almost equal amounts of the three types of equities with no fixed income at all. So if you had to put labels, conservative, aggressive growth, or balanced, for each of the pie charts, try it for yourself, and we'll come back to this a little later. So, the bond market. First of all, what is a bond? A bond is a security that has an asset attached. So, for example, mortgage bonds had an asset attached. Government bonds have an asset attached, which is the ability to tax. So they can always be covered. Now, what's the difference between a bond and a debenture? Well, a debenture does not have an asset attached. It has what is attached is the good credit of the company. So, what's a bond? What's it look like? What makes bond prices move? Let's look at bond pricing and examples. Profiting and losing money in the bond market. How do you buy bonds? And different type of bond investors. Well, if you go to slide 8, you can see a replica of a traditional bond. This one is a provincial government bond. It's a bond issued by the province of Ontario. It's got a $20,000 face value. It's got a 5% coupon, and its final maturity date is October 15th, 2023. Now, what you can see is that there's what's called the residual, which is on the left, and it's got the coupons, which are the two columns on the right. Now, if you have a careful look at the coupons, and in the old days, what you would do is you would go into the bank branch and you'd clip off a coupon, and they'd give you the value of the coupon and keep the coupon. In the end, you would be left with no coupons. You'd have the residual. You'd go and hand the residual in, and you'd get the principal back. Now, what's wrong with this bond? The way it's laid out. Well, guess what? As you can see, the way the coupons are laid out, it'd be very difficult to get to the first coupon, the one which you'd be entitled to on April 15th, 2014, because you'd have to get past the later dated ones first. This thing should actually be laid out with the earliest dated ones to the outside so that they could all be clipped off and you'd be left with the residual at the end. Anyway, it's an interesting exercise. You never see these anymore. They're always kept in people's accounts. So this is just a curiosity at this point. But it does explain how bonds do work. So in this case, as we talked about before, you see the issuer is the province of Ontario. It's got a face value of $20,000. It's got a 5% interest rate. The issue date is October 15th, 2013. The maturity date is 10 years later in 2023. Payment frequency is semi-annual, and each payment is $500. In other words, every 6 months. So what makes bond prices move? Well, let's look at interest rates, risk of the issuer, and the economy, which we'll look at a little bit later. So, interest rates and price. The thing to remember with bonds is that when interest rates go up, bond prices go down. When interest rates go down, bond prices go up. So, the other factor to consider is the risk rating. And bonds are rated from AAA to B or single B or even C. Clearly, not clearly, but you need to know that AAA bonds are the best quality ones, and everything down from A through B and C and so forth are worse quality. So if you want to be conservative, stick to A-rated bonds or better. Know that triple B bonds, triple B minus is the lowest credit rating for investment grade bonds. And triple B bonds are satisfactory for provincial bonds and many corporate bonds. Anything below investment grade is called high yield or junk debt. So don't accept good quality as an answer. Know what the credit rating is. And a conservative bond fund should contain less than 30% corporate debentures and a very controlled amount of high yield investments or junk investments. So also, as the economy changes, in other words, becomes favorable or less favorable, bond prices can change radically too. So let's look at bond price movements and how it can, a couple of exercises to highlight this. So in the first exercise, let's take an environment where rates fall 2%. So we've got a 5-year and a 20-year bond. Both have, they started off with $100 face value. We're looking at it in October 15th, 2016. 5-year government bond is now, interest rates have fallen 2%. The Government of Canada 5-year bond maturing October 15th, 2021, the value would be 109. The 20-year bond maturing October 15th, 2036, its value would be $130. So that's a large capital gain. But what if interest rates were to go the opposite direction? What if interest rates rose 2%? So you start with $100 face value, just as you did before. However, if interest rates were to rise 2%, that 5-year bond would be worth $91.50, and the 20-year bond would be worth $78.50. So clearly, in a declining interest rate environment, you get your interest payment and a capital gain on your principal. In a rising interest rate environment, you get your interest payment, but erosion of capital. So, how do you buy a bond? Well, they're priced just like stocks. They have a bid and an ask, and you have to take account of accrued interest. If you want to know more, there's a bond calculator at the bottom of slide 12. So bond price rules. The longer the maturity date, the more volatile the price of the bond, and vice versa. The price of the bond is affected by changing credit rating. Bonds mature at the original issue price of $100. Don't forget that. You buy the bond at $130, you're looking for the yield, but you're going to see you're going to receive some of your money as an interest payment along the way, as opposed to a gain or loss at the end, because when the bond matures, you bought it it was originally issued at $100, it matures at $100. So you can make a significant amount of money trading bonds in the right environment, and you can make some good capital gains. But buying and selling bonds makes you a rate anticipator, and bonds certainly move up and down with rates, sometimes strongly. Looking at preferred shares, they're sort of like a quasi-bond. They're similar to stocks in that they pay dividends, not interest. They probably don't have a final maturity. Many of them are perpetual, and they trade on the stock market. But they're also similar to bonds. because they have a preferred dividend, which is a fixed dollar amount and is paid in preference to any common shares. Typically, the dividend on a bond, on a preferred share can't be changed without a ruling of the board of directors. Preferred shares are typically issued with a par value of $25, but like bonds, the prices are very sensitive to interest rate movements, and they also have a credit rating, but in the case of preferred shares, they tend to be P1, P2, P3. And again, P1 are the best quality, P3 lesser quality. And preferred shares may have all sorts of special features. So when you go to buy a preferred share, good idea to either know what you're doing or take advice from your trusted wealth professional, because you really need to know about all the special features. So here are some examples of preferred share features. First of all, the preferred shares are issued at $25. They have a set dividend, pays quarterly. So some of the preferred features, you could have retractable bonds where the investor has an out. You could have redeemable bonds where the issuer has an out. There are fixed floaters. There are rate reset preferreds, very popular today. And in fact, there's a commentary which you can watch after this lesson. There are perpetual preferreds and convertible preferreds. All of these different types of preferred shares tend to get issued in a market environment which is favorable for that particular feature. So many of these features are not even available in current preferred shares because within the time frame that the preferreds were issued, those features weren't popular features for new issue preferreds. Now, taxation of income. Interest income is taxed at your marginal tax rate. So in other words, you make 100% of interest, it's taxed at your marginal tax rate. However, capital gains income, the way it works is that 1/2 the capital gain is exempt from tax and the other half is taxed at your marginal rate. So what it really means is that in essence, you can take your marginal tax rate, and if you want to apply it to capital gains, you divide it by 2, and that's the tax rate for any capital gains you have. They're reported in the appropriate spot on your tax return, so that gets taken care of quite easily. Finally, dividend income, a little more complicated, but eligible dividends earned from Canadian corporations are grossed up by 38% in 2012, and it changed in subsequent years. Then the federal dividend tax credit of 15.02% is applied. So, for example, on $100 of dividend income, it grosses up to $138. Then you put the federal tax on at $40.02, dividend tax credit at $20.72. The net federal tax is $19.30, net provincial tax $6.57, total tax $25.87. So you keep $74.13. Still better than regular income, not quite as good as capital gains. Very similar though. So let's look at taxation of income summary. Interest income, if you earn $100,000 as of June 30th, 2016, your marginal tax rate on interest income for a $100,000 income earner would be 43.41%. Dividend income would be 25.87%, and capital gains income would be 21.71% tax. So clearly the best is capital gains, followed by dividends, and the least attractive is interest income. There are 2 types of fixed income investors. They're conservative fixed income investors who buy high quality bonds or debentures, BBB or higher. They want income from the bonds and they hold them to maturity. They just basically, very often, in fact, insurance companies do this. They buy the bonds when they're new issue. They hold them to maturity. They look at the coupon as the return that they expect from the investment, and they don't take any risk, or they only take the risk associated with the credit worthiness of the bond issuer. Then there are more aggressive bond investors. These are people who trade bonds. They tend to hold them for a shorter term, maybe 3 months or a year. They try to anticipate interest rate movements, and they may even buy long bonds to maximize their return. If they want to be extra aggressive, they buy them on margin. Now they've got margin coupled up with their interest rate forecasts. If everything goes well, they make a lot of money. If it doesn't, they can lose a lot of money. That's why they're aggressive investments. And that is the end of session 2. Thank you for listening.